What's up everybody, I'm Jaspreet Singh and we could be seeing one of the largest transfers of money ever because there are three factors coming together. First, we have this global debt crisis that is becoming imminent around the whole world. Second, we have the slowdown in the economy that we're facing here in the United States. And third, baby boomers, which are the largest generation to ever hit retirement right now, are about to retire and pass down their assets. Each of these three factors individually would result in a huge transfer of wealth because on one hand, if you have this global debt crisis where you have civilizations around the world on the verge of defaulting on their debts like we're seeing happening right now, that would change the way that money is done, which means that some people would become incredibly wealthy and some people would become incredibly poor. On the second hand, you have a slowdown in the United States economy. Anytime you see a recession or a depression, doesn't matter. Anytime you see a slowdown in the economy, again, it creates an insane amount of wealth for some people and it makes some people very poor. And then you have this massive generation, the boomer generation, which is now entering retirement. And they are planning now on how to pass down their assets, which up till now is the largest amount of dollars that will be passed through traditional estate planning. Now, of course, not everybody is going to have a rich boomer parent or a grandparent who's going to pass assets down to them, but there are trillions of dollars worth of assets which could potentially be passed. And then when you combine that with these other two factors, this is what's creating a massive potential opportunity to build wealth and also a massive opportunity where now wealth will be transferred from one place to the next. I haven't personally on this channel been talking too extensively about what's going on in terms of the global debt crisis. I've been focusing on the stuff that's happening here in the United States, but there's a few different factors coming together. On one hand, Sri Lanka, the country that's just south of India, has already defaulted on their debts. And now the World Bank says that about a dozen or so other developing countries could default on their debts, and then on top of that you have dozens of other countries that are potentially on the verge of famine or food shortages because of everything going on in Ukraine. I mean, just look at Lebanon. We've seen the price of food in Lebanon grow by over 1,000% in just the last year or so. The unfortunate reality is anytime you see some sort of economic struggle like this or economic default, it creates a widening wealth gap between the haves and the have-nots, which is why it's so important for you to be financially educated and understand what's happening. These types of debt crises come down to really one root cause. It's when the government spends more money than it earns. So you earn a certain amount of dollars from taxes and then you spend money to help run the government and run the country. And when your expenses exceed your income, well, then you have to go out and take debt. And then if you continue to do this and you keep racking on more and more and more debt to fund your operations, to continue running the country, well, eventually you will hit a breaking point where now you cannot keep making your payments. And when you hit this sort of default, like we saw happen in Sri Lanka, well, that's when you can see a lot of economic uncertainty. The currency can collapse, the economy can collapse, and it causes a whole bunch of issues, but it ultimately comes down to the way that money is spent versus earned. When you spend a lot more than you earn, you risk default, and during the entire process, you continue to create a widening wealth gap between the haves and the have-nots because you will always have people who are more financially educated than others. And when you print more money, or when you go and rack up this sort of national debt, well, then the value of your currency gets devalued, it creates inflation, and inflation disproportionately affects the poor and the financially uneducated, while it more disproportionately benefits the wealthy. This is why you start to see more of an extreme wealth gap anytime you see more of these types of debt crises, anytime you see more of inflation, because some people will understand it much better than others. So let's take a look at what's going on here in the United States. Here's a chart from the Federal Reserve Bank that shows the M1 money supply of dollars. I'll explain what that means, but just for now, understand that it's the amount of dollars out there. And what you'll see is that in 2019, I'm showing from 2019 until now, in January of 2019, there was about $3.7 trillion out there. You go to January of 2020, there was about $3.9 trillion out there. And then suddenly between March, April, and May, you saw this massive spike in the amount of dollars out there. Now, what happened during this time? Well, for one, we had the pandemic, and then the Federal Reserve Bank started an unlimited amount of quantitative easing. So you can see in March of 2020, there was about $4.2 trillion out there. And then you go to May of 2020 and it's 16 trillion. You go to May of 2022 and now it's around 20 trillion dollars. So you can see this massive just explosion in the amount of dollars out there. If you really want to understand the impacts of this, you have to first understand what does M1 mean. And the easiest way to do that is just go to Investopedia, and it says that M1 money supply is a narrow measure of the money supply that includes currency, demand deposits, other liquid deposits, and savings deposits. In other words, M1 is the amount of cash and dollars out there. Now, the interesting thing about this M1 money supply chart that the Fed put out is that when you see this massive spike in the amount of dollars out there, the Fed also at the exact same time started to change the definition of M1. So they expanded the definition of M1, which allowed more dollars to be classified under this M1 label. And the question is, why did they do it then? Why did they change the definition of M1 as soon as it started unlimited quantitative easing in 2020 to fight the pandemic? Now, of course, I don't know this for sure, but if I had to make a guess, I would say that it's so that we don't know for sure how much money was exactly printed in 2020, because during that time when the pandemic hit, the Federal Reserve Bank started an unlimited quantitative easing program. They started all the stimulus into the stock market, into companies, into people through the form of stimulus checks. So we saw so much different forms of stimulus being created. And if people knew how much money was actually being printed, being created, and being injected into our economy, maybe more people would get upset or they'd get worried about what's going on. But instead, they also changed the definition of M1. That way, they can kind of hide what's actually going on with a little bit of other ambiguity. Now, of course, I don't know this for sure. It's just a guess, and you can come up with your own theories as well. However, what we do know for sure is that during the 2020 pandemic, we saw an insane amount of money get created essentially out of thin air, and it was injected into our economy. All of this new inflation, the new money printing, has devalued the value of our dollars, our currency, and this is a big contributor to the rising prices around us, causing a massive amount of inflation. Now, while the Fed is now, in today's time, trying to fight inflation, we still have a huge massive inflation problem that will not be going away anytime soon. And what does that do? Well, it makes some people insanely wealthier and it makes other people insanely poorer. I want you to understand this. That way you can understand how the system works, because at the end of the day, inflation is a silent tax. If the government wanted to spend more money and they didn't have the ability to just print money out of thin air, if they couldn't work with the Fed to print an unlimited amount of money, what would they have to do? Well, either they spend too much money and then they default, which would cause an economic collapse, or they have to raise your taxes, because that's the only other way that the government can raise money without going out and getting debt from somewhere else. If the government wants to spend more money without going into deeper debt, without borrowing money from the Fed, without printing money out of thin air, they have to raise their taxes. And what would happen if the government started raising your taxes in the middle of an economic crisis like the pandemic? People would freak out and they would not agree to that. So instead of actually raising taxes to cover their higher costs, what do? They create inflation, which is a silent tax, which everybody has to pay for, but inflation causes disproportionate pain for the have-nots compared to the haves. So this is where financial education is so important, and that's the first concept that you want to understand, because this problem is not going away, and it looks like this problem might continue to get worse, which brings me to number 2. Second, we're seeing an economic slowdown happen here in the United States, and a big contributor to this economic slowdown is this massive amount of inflation that we're having right now, because the cost of everything has gone up so much that people just don't have the same amount of money as it did before left over after paying for the necessary expenses to go and spend and shop. This is creating an economic slowdown because now people can't go out and just buy things because, well, gas is expensive, rent is expensive, food is expensive, and so your necessary items nowadays are taking up such a bigger percentage of your income that most people don't have leftover cash to just go out on a vacation and to just go out and go shopping. What is that doing? It's hurting these other businesses. You can start to see the different factors coming together, because now on one hand, we have this much higher cost of living, making it harder for people to survive. And then you have businesses that are making less money because of this economic slowdown, leading to layoffs. So you have people that are losing their jobs while the cost of living is still going up. So what does this do? Well, it causes one layer of assets and money to get wiped away, and then it causes a second layer of assets and money to go on discount. Let me show you what I mean. Let's assume that you own this home right here, and I'm going to draw you, for our male followers, a mustache, or as we like to call it in my native language, Punjabi, a much. And for our female followers, I'm going to draw you a braid, or as we like to call it in Punjabi, a gut. So you bought this home, for example, for $100,000 a number of years ago. And then a lot of people decided to move into your neighborhood, into your city, and home prices exploded. You bought the home for 100 grand, and then the market value of your home went up to $1 million. Now you're very happy because you feel rich. You have a lot of money on paper. Now, of course, you don't have this $1 million unless you actually sell your home, but on paper, you have a home worth $1 million because that's the value of your home. So now you're a millionaire on paper. But then something happens. You were cooking some Indian food and something got leaked, the oil leaked, and then the house burned down, and now you have no insurance. So now your $1 million home dropped in value to what? Nothing. Let's assume that the land is worthless just for the sake of this example. How much money did you lose in this example? Well, you lost $1 million worth of value, but you never actually had $1 million. Remember, you only invested 100 grand into this. So you lost your 100 grand that you invested, but you also lost $1 million of potential value that you had in your hands, but now it's gone. This is what happens when an asset becomes worthless. Money gets lost, and then invisible money gets lost as well. But now, let's take this one step further, and let's assume that you didn't burn it down because it was Indian food. Let's now say that it's something systemic, where now a bunch of homes are being lost. They're being wiped out. Maybe there's termites or some sort of invisible problem. I can't come up with a better example right now, where homes are just being destroyed, and now less and less people want to continue owning their homes because they want to cash out before they lose the value of their homes. So what does this do? It starts to create fire sales. Even if a home is in a good location, it's not going to lose its value. That homeowner might still want to sell quickly because of fears of home values going down and of fears of their home being wiped out. So what does that do? It creates discounts in other assets. So you have one layer of assets that will get wiped out. These were the badly managed assets. And then you have the second layer of assets that may or may not have been badly managed, but also get hurt because of the badly managed assets losing the valuations. So what does that do? It creates opportunity now for people who can identify the good opportunity to buy assets at a discounted price. Anytime you start to see more economic uncertainty and economic slowdown, you will see the valuations of companies and other assets drop, because now not only are some companies, the bad ones, starting to lose, starting to hurt, maybe even getting wiped out, but then the good ones will also get hurt because people get scared of what's happening with the bad ones. This creates opportunity for you to come in and buy some of the good assets, whether it's stocks, whether it's real estate, maybe even it's cryptocurrency, if you can find the good assets, because now you can come in and find some of these to buy at a discounted price, but it requires you to be financially educated in that space. But I also want to mention one thing, because the factor that you want to pay attention to in this case is what the Federal Reserve Bank is going to do, because most people assume that if the economy is crashing, that the stock market and these other assets have to crash in price. But it depends, because if the Fed changes course, then it could change what happens in the markets. Currently, at the time when we're recording this video, the Fed is working to raise interest rates to fight inflation. They're not worried about the economy right now. The Fed says that the economy is very strong, it's robust, there's nothing to worry about. So what are they doing? They're focusing on inflation. They're raising interest rates to fight inflation, meaning they're pulling money out of the economic system, which hurts companies, which hurts asset prices, because now they want to fight inflation. They want to protect the dollar. But if things change, and then the Fed says, okay, the economy needs more attention right now. The Fed doesn't want to fight inflation anymore. They want to fight the economy. Well, that means that they would create more inflation. They would cut interest rates, they would do more stimulus. If the Fed does that, then you could potentially see assets crash upwards, because now people are worried about the dollar, because now the Fed is willing to create more inflation. They're willing to risk the health of the dollar to potentially save the economy in the short term. And so that could cause asset prices from stocks to real estate, maybe even cryptocurrency, to go upwards, because now people want to get out of whatever cash that they have and own the assets. However, if the Fed stays true to fighting inflation, because they are worried about the health of the dollar, and they continue to raise interest rates even if the economy slows down, that would cause a crash in the markets, because, well, it keeps pulling money out of the system. It would hurt companies. Some companies will go under. It would hurt asset prices. It could hurt real estate prices. So we don't know what the Fed is going to do. However, that's what you want to pay attention to, because the interest rates will play a major determining factor in what's coming next in our economy and asset prices. Now, before I move on to number 3, I do want to say, if you're looking for an easy way to stay up to date on what is happening in the finance and business world as it is happening, you can check out Market Briefs. It's a free financial newsletter that I created every day. My team breaks down what's happening in the top finance and business news. They're spending hours every single day going through news story after news story after news story to dissect what's going on, and then they break it down into a fun, easy to read, witty, and entertaining newsletter. You can read the email in less than 5 minutes every morning, and I can promise you that you're going to look forward to reading this email every morning because it's fun. You're going to actually enjoy reading this email. It's completely free, so if you want to join Market Briefs, I'll put the link to how you can do it down in the description below. And then the third factor that we have is that we have the largest generation right now to retire ever. Now, baby boomers are not the largest generation ever. There's more millennials than baby boomers. However, baby boomers are the largest generation to retire yet. There's just over 70 million baby boomers, and the average baby boomer, rather the median baby boomer, has something around $200,000 put aside for their retirement. So now if we multiply this and add it together, if each baby boomer, we just say, has $200,000, that would mean, quick math, that there's about $14 trillion worth of assets here with the baby boomers that has the potential to be passed on. Now, of course, just like with everything else, you're going to see a big imbalance because some people are going to get nothing, while others are going to make millions through this transfer of wealth. However, the thing that I want you to pay attention to is what's going to actually happen to this money, because this money is going to flow to the Generation Xers, it's going to go to the Millennials, and then it's also going to go, in some extent, to Generation Zers. And most of these generational people are going to spend money very differently than the way boomers spend money. I mean, Generation Zers and Millennials especially spend money extremely differently than the way boomers spend money. So what does this mean? It's going to change the dynamics of the economy. Millennials and Generation Zers will have maybe some more buying power to things that are more interesting to them. This is where it really pays to be financially educated, not just if you're getting the money, because if you're getting the money, obviously you want to do something smart with it. I have tons of videos on this channel talking about how to invest your money the right way, but more in the sense of understanding the future of the economy. Like to say, you want to skate to where the puck is going, not to where the puck is today. So you want to understand, as the buying power of people will transfer to younger people over time, what will change in our economy, because younger people have a completely different stance when it comes to spending money than older people. Younger people care a lot more about social causes. They care a lot more about things like environmental issues. They care a lot more about the why, not just the product that itself. They want to know the purpose behind things. So it's going to change the way that our economy runs, which should also change the way that investments run. So this is where you want to start paying attention to the changes in our economy, not just what's happening today, because our economy isn't stagnant. Things change every single day, and these are the factors that you want to pay attention to. And anytime you see money change hands, whether it's in the form of inflation, whether it's in the form of a recession, whether it's in the form of estate planning, it changes the way that the economy will move. And again, it will make some people significantly wealthier, and it will make some people significantly poorer. What I'm trying to get at in this video, and with the videos on my channel, is to get you to, one, understand this. That way you can be one of the people that benefit from the system, because the system is, it is what it is. Okay, you can hate it, you can love it, but it is what it is. This is where it pays literally for you to be financially educated, for you to be aware. That way you can take advantage of everything going on around you, because if you don't, you're just going to continue to be a pawn in the system. You're going to continue to be abused. You're going to continue to be used. This is where I want you to be financially educated. That way you can benefit, use it to your advantage. That way now you can use the system, you can learn the rules to the game, and you can be one of the people that become wealthier from everything else that's going on. And then once you do that, you can take better care of yourself. You can take better care of your family, and you can take better care of your community. But it starts with the right education, and it starts with understanding what's going on. If you enjoyed this video and you want to see how you can take advantage of this once-in-a-lifetime opportunity to build wealth, I made a video covering that, and you can watch it by clicking this button right over there. Thank you for watching, and as always, keep hustling. So regardless of whether or not we're going to see a recession in 2022 or 2023 or 2024, the reality is we have been kicking this inflation can down the road for a long time, and we've been really putting off a lot of issues